Welcome to another insightful session with Informed Investor. Imagine owning a piece of company that not only grows in value but also sends you a little thank you paycheck regularly. Think of it as a subscription service where you are the one getting paid. Or let's take another example. Imagine planting a mango tree where you water it, take care of it, and one day it starts giving you delicious mangoes season after season. That's similar to how dividend paying stocks work. They offer investors a triple treat: regular income through dividends, steady cash flow, and the potential for capital appreciation over time. In a world where fixed deposits offer modest returns and real estate demands hefty upfront investments, dividend stocks emerge as the unsung heroes of passive income. In this video, we'll talk about dividend paying stocks and leave you with the top 5 stocks that will help you enjoy a steady stream of income while your investment grows in value. Let's begin. You're watching Informed Investor, an initiative by Equentis. Now, to start off, dividend stocks are shares of companies that distribute a portion of their profits to shareholders on a regular basis, typically quarterly or annually. These payouts are a way of companies to reward investors for their ownership and can be seen as a sign of a company's financial health and stability. Investing in dividend stocks can provide a steady income stream, which is especially attractive for those looking for passive income. The dividend payment process involves 4 key dates. First is the declaration date. The company's board announces the dividend and mentions that they will pay X amount of rupees per share on a particular date. Second is the ex-dividend date. This is the date of the cutoff to own shares and qualify for the dividend. Investors will need to possess shares before this date or they will miss out on the dividend. Third is the record date. The company checks its records to confirm eligible shareholders. Last is the payment date. This is the day when the money hits your bank account and you receive a notification of the payment. Let's run through an example of an upcoming dividend of ITC Limited. On 22nd May, ITC's board recommended a final dividend of 7.85 rupees per share for FY25 subject to shareholder approval. This is the declaration date. It also mentions the record date as 28th May 2025 for ITC shareholders. And remember, you need to hold shares in your Demat account before this date to qualify and be eligible for the dividend. Ex-dividend date is usually 1 to 2 days prior to the record date. And lastly, the payment is expected to be done between 28th July and 31st July 2025 to the shareholders. Dividend-friendly sectors typically share common characteristics. They often comprise mature businesses, exhibit stable cash flows, and experience consistent demand for the products or services rather than being categorized by rapid, high-growth startups. In India, several key sectors are renowned for their consistent dividend payouts. The oil and gas sector is known for its stable cash flows and frequently includes government-linked companies or public sector undertakings such as ONGC and BPCL, which are often reliable dividend payers. Segments like refining, marketing, and exploration contribute to this stability. Although capital intensive and subject to cyclical trends, many established players in this sector, including Coal India and Vedanta, have a history of being dividend friendly. Categorized by steady demand and moderate growth, companies in the chemical sector often contribute to consistent dividend distributions. Then comes logistics and port companies, which are infrastructure-driven businesses that benefit from consistent revenue streams, which typically translate into dependable dividends. As a mature and stable sector with consistent consumer demand, companies like ITC, with its significant FMCG presence, are often dependable sources of dividend. Companies providing essential services within the utility sector include those focused on electricity generation, transmission, and distribution, along with companies providing water and gas services, are highly stable, leading to predictable earnings and consistent dividend payouts. Next, many companies in the IT services sector are categorized by strong cash flows and a capacity for innovation, enabling them to consistently reward shareholders with dividends. Lastly, pharma is another stable and essential sector where many companies consistently pay steady dividends. Now, to build a reliable inflation-beating passive income portfolio, we aren't just chasing a high dividend yield. We're looking for companies that pay dividends consistently, grow profits year after year, and use capital efficiently to drive long-term shareholder value. To shortlist such high-quality stocks, we have used a powerful combo of dividend, growth, and efficiency metrics. Let's break them down. First is the dividend yield. This is the annual dividend per share divided by the stock price expressed as a percentage. This basically tells you how much cash return you are getting on your investment today. A higher yield means more income for every rupee invested. For example, a 100 rupee stock paying 6 rupees annually has a 6% yield. The second metric is the profit after tax compounded annual growth rate over a 5-year period. This measures how fast a company's net profit has grown over the last 5 years. Steady growth in PAT means the company has a strong business model and can afford to keep increasing dividends. A high CAGR like 15% indicates robust financial health. Then next is the return on capital employed. This measures how efficiently a company uses its capital to generate profits. A ROC of 20 or higher means the company is making more money with less capital, suggesting better scope to pay and grow dividends. It also suggests excellent capital efficiency. Next comes the dividend payout ratio. This is the percentage of profits paid out as dividends. A stable ratio, say between 30 to 50, indicates sustainable dividends. Too high, for example more than 100%, might raise concerns about reinvestment. Lastly, we have the debt to equity, which compares a company's debt to its equity. Basically tells us how leveraged the company is. A low ratio like 0.5 means less debt, reducing the risk of dividend cuts during tough times. Now, when we put all of these metrics on a screener, we found out the companies that made the cut. These companies have the perfect mix of dividend payouts, earnings growth, and capital efficiency. Basically, these companies offer a sweet mix of income and growth. So now let's focus on these top 5 companies from different sectors, understand the business overview, financial performance, future growth and dividend plans, and set the tone for a steady cash flow through these stocks. The first name on the list is ITC Limited, a diversified conglomerate with significant presence across various sectors including cigarettes, hotels, paperboards, packaging, agri-exports, and a rapidly growing fast-moving consumer goods portfolio. While it dominates the tobacco market with around 80% market share, it is actively gaining market share in the FMCG segment, which encompasses packaged foods, confectionery, branded apparel, personal care, and stationery. A couple of years ago, it also reached a milestone and became the 11th company to cross the 5 trillion market cap. Now, talking about dividend policy, ITC is a dividend darling with a payout ratio of 92.4% and a current yield of 3.29%. It has consistently paid both interim and final dividends, as you can see on the screen. We also have two important metrics on the screen. CAGR dividend is the return generated by the addition of dividends over the years. This means with dividends, the stock has appreciated by 7.83% every year over the last 5 years. But the beauty of it is also that the stock has appreciated over time. If we consider the capital appreciation along with the dividend, ITC has generated a CAGR of 25.5% returns. Now imagine an investor bought one share of ITC on 6 July 2020 when the share was priced at 166.76 rupees. Since then, the company has paid out 76 rupees per share in dividends. That means without selling the share, just by holding it, the investors have already recovered about 45.6% of their initial investment only through dividend payouts. And this doesn't even include the share price appreciation, which has jumped to over 440 by May 2025. Now, in terms of financial performance, ITC has been a steady performer. Its sales have grown at a compounded rate of 8.8% over the last 5 years, while profits have grown at 17.6% during the same period. The company boasts a strong return of equity of 29.7% over the last 5 years, and in fact, for FY25, ITC reported a net profit of 35,052 crores, a massive 68% from last year. However, this was due to a one-time gain of the demerger of ITC Hotels Limited. Another point to highlight is that ITC's cigarette business continues to generate steady cash flow, and the last 3 years has witnessed no additional taxes on the cigarette segment. Now looking ahead, ITC is investing 20,000 crore over the next 5 years, with 35 to 40% going into the non-cigarette FMCG business, 20% towards paperboards and packaging, and the rest towards the agri-business and innovations. This has led to several strategic moves, including acquiring several businesses. It's also diving into health and wellness products and value-added agriculture like medicinal plants and a climate-smart farming, all looking good for the long term. To sustain future dividends, IDC's diversified revenue streams, especially from its growing FMCG and the agribusiness segments, will ensure stable cash flows. Its zero debt balance sheet provides flexibility to maintain high payouts, while cost optimization in its cigarette business will support consistent profitability, making dividend continuity likely. Second on the list is ONGC, India's largest player in the country's oil and gas sector, primarily involved in the production and sale of crude oil and natural gas. Crude oil is processed into petrol and diesel by refiners, while natural gas serves various purposes, including electricity generation, fertilizer production, CNG, and domestic cooking. Its international arm, ONGC Videsh Limited, also contributes significantly to its oil production from overseas assets. In terms of dividend policy, ONGC has a history of consistent dividend payments, often declaring interim dividends multiple times a year. ONGC maintains a solid dividend policy with a payout ratio of 33% and a current yield of 4.9%. If an investor had bought ONGC at 64.45 back in March 2020, they would have already recovered a whopping 83.2% of the acquisition amount through dividends alone. Talking about financial performance, ONGC has seen a strong sales growth of 10.8% over 5 years, while profit has been volatile, growing at 27.3% over the last 5 years. However, FY25 did see a notable drop in net profit to the tune of 38,329 crore, a drop of 31% due to lower price realization, higher exploration costs, margin compression, and mediocre performance over the last 4 recent quarters. In terms of capital efficiency, ONGC has ROC and ROE of around 11% for the last 5 years. Considering future plans, ONGC is investing 1 trillion in clean energy by 2030, aiming for 10 gigawatts of renewable energy portfolio. It's also exploring gas hydrates and targeting net zero emissions by 2038, balancing traditional energy with sustainability. For future dividends, ONGC's focus on diversifying into renewables will reduce reliance on volatile oil prices, ensuring stable cash flows. Its low debt to equity ratio of 0.36 times supports financial flexibility and operational efficiencies from new exploration projects, which will bolster profits, enabling consistent dividend payouts. Next up is Coal India, a Maharatna public sector undertaking under the Ministry of Coal, Government of India. It holds the distinction of being the single largest coal producing company globally and one of the large corporate employers. Coal India operates across 84 mining areas in 8 Indian states, managing 313 working mines. Its primary consumers are the power and steel sectors, with other sectors including cement, fertilizers, and bricklayers. Talking about dividend policy, Coal India is another dividend superstar known for its consistent and generous dividend payouts, making it one of India's top dividend yielding stocks. It has a payout ratio of 49.8% and a current yield of 6.5%. Its historical payout averages 45.1%, reflecting its shareholder-friendly approach. Coal India's dividend story is equally impressive. An investor who bought the stock in March 2020 at 154.1 rupees would have already recovered 75% of their investment just through dividends in the last 5 years. Talking about financial performance, Coal India has a steady sales growth of 8% over the last 5 years, while profit growth had been stronger at around 17%. However, similar to ONGC, Coal India's FY25 performance took a small dip due to lower price realizations and higher exploration costs. Net profit declined 5.5% to 35,302 in FY25 from the previous year's 37,369 crore. Revenue also marginally increased by 0.7%. However, on the positive side, ROE is exceptional, averaging 45% over the last 5 years. Talking about the future plans, Coal India is focused on enhancing domestic coal production and diversifying its operations. It's also investing in green mining and renewable energy with plans for 4.5 gigawatts of solar power by 2025-2026, aligning with India's energy and sustainability goals. To maintain dividends, Coal India's dominant market position ensures steady revenue from coal demand, while its near to zero debt provides ample cash flow for payouts. Investments in cost-effective mining technologies will further enhance profitability, supporting ongoing dividend commitments. Next on the list is Bharat Petroleum Corporation Limited, which is a leading public sector undertaking in India primarily engaged in the refining of crude oil and the marketing of petroleum products. The company operates refineries in Mumbai, Kochi, and Bina with a total refining capacity of 35.3 million metric tons per annum, accounting for approximately 14 to 15% of India's total refining capacity. In terms of dividend policy, BPCL has a strong track record of consistent dividend payouts, having declared 41 dividends since 2001, solidifying its reputation as a shareholder-friendly PSU. BPCL's dividend payout ratio is 31.4% with a current yield of 3.2%. BPCL stands out as the most compelling example. An investor who bought the stock in March 2020 at 158.93 rupees would have already recovered nearly 96% of that investment purely through dividends. That's the power of consistent and generous dividend payouts. Talking about the financial performance, BPCL's financial performance has shown resilience despite market volatility. BPCL sales have grown at a CAGR of 9% over 5 years, while the profit has grown stronger at 29.5% over 5 years. Its return on equity averages at around 20% over the last 5 years. Talking about future plans, BPCL is investing 1.7 trillion over the next 5 years in green energy and petrochemicals, aiming for net zero emissions by 2040. It plans to expand refining capacity and add over 4,000 fuel stations. For future dividends, BPCL's expansion into petrochemicals and green energy will diversify revenue, reducing exposure to oil price volatility. Its moderate debt-to-equity ratio of 0.61 times allows for sustained payouts, while improved refining margins and cost efficiencies will generate the cash needed to maintain dividends. Moving on to the company that rounds up the top 5 is Nippon Life India Asset Management Limited. Formerly known as Reliance Nippon Life Asset Management Limited, it is one of India's largest asset management companies, managing a total asset under management of 6.54 lakh crore. Its principal activities include managing mutual funds, including exchange-traded funds, and managed accounts such as portfolio management services, alternative investment funds, and pension funds. It also handles offshore funds and advisory mandates. The company is promoted by Nippon Life Insurance Company, a leading Japanese insurer with a vast global network. Talking about dividend policy, Nippon Life India Asset Management has a history of consistent dividend payments. In the past 12 months, it has provided a dividend of 19 rupees per share. The current yield is 2.4% and the payout ratio stands at 95%, which is a very high ratio, suggesting that nearly all of its earnings are distributed as dividends. Now let's look at Nippon Life India AMC. An investor who picked up the stock in February 2020 at 314.2 rupees has received 60 rupees in dividends so far, covering around 19% of their original investment. While the dividend payouts have been modest, the real story lies in its capital appreciation. The stock has more than doubled since then, showing how some companies reward investors not just through dividends but strong share price performance too. In terms of financial performance, the company has witnessed strong sales growth of 13.4% over the last 5 years. Profit growth is even impressive at 25% over the last 5 years. ROE averages 23% over the last 5 years, with 31% last year. Talking about the future plans, the company is expanding its product offerings, enhancing digital capabilities, and aiming to grow its market share in the asset management industry. To sustain dividends, Nippon Life's growth in assets under management, driven by India's rising investment culture, will boost revenue. Its debt-to-free status ensures strong cash flows, and operational efficiencies from digital platforms will support high payout ratios, making future payments likely. Well, that sums up our top 5 list. Now, to conclude dividend-paying stocks, I like the dependable friends who always show up with a gift. They offer a blend of regular income and potential growth, making them a fantastic choice for investors seeking stability and cash flow. Our top picks, ITC, ONGC, Coal India, BPCL, and Nippon Life India, stand out for the strong financials, consistent dividends, and strategic plans to ensure future payouts. However, remember, dividends aren't guaranteed. They come with risks like potential cuts or tax implications, with 10% TDS on dividend income above 10,000. So it's crucial to do your homework and diversify. With the right approach, dividend stocks can be a cornerstone for balanced portfolio, helping you build wealth while enjoying those regular payouts. Having said that, this is me, Rahul Hassan, signing off. Take care and stay invested.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.